Hey everyone, welcome back to the Weekend Charts. Big show this week. I'm your host, Charlie Bilello. As always, we're going to take you on a tour of markets and run through the most important charts and themes that I'm seeing today. And I want to start out with the US equity market and what's become the largest drawdown of the year for the S&P 500. So it's been a while since we had a pullback. We had that pullback back in February and March, a little bit under 8%. This is even bigger now, close to 10% on a closing basis. Intraday, we actually got above that 10% drawdown. So decent type of decline here. Investors had that smooth advance from the lows in March through the peak in July. And since then, a little bit more volatility for investors. But in a historical basis, this is nothing unusual whatsoever. This is the typical volatility you see almost every year in the markets. And just to illustrate that, we're looking here at a chart of intra-year drawdowns. So looking at the peak in the market for a year and the biggest decline off of that. And you can see each and every year there's a drawdown. It's just a matter of how big it's going to be. And the average year actually has a 16% drawdown historically. And now we're at close to 10%. So still a relatively mild year in comparison to the average. And if you look at the right column there, you can see the S&P 500 on a total return basis actually still up 9% despite this drawdown. So it's kind of a feature of the market, not a bug, that you have this type of volatility, because it's the reason why you have these long-term returns of around 10% per year for the equity market, is because you have to stomach these types of declines pretty much each and every year. So in terms of the odds, what should investors expect in terms of intra-year volatility? I put together this table here. Pretty much every year you have at least a 5% decline. 10%, like we're seeing right now, happens every 1.6 years. So not every year, but almost every year. If we're looking at 20% decline, it's every 4 years on average, 25% every 5 years. Now, these are just historical averages, but the message is clear to investors. If you're a long-term investor, you're looking out 20, 30 years, you're going to experience a number of these declines over the course of your investing journey. So if you look at the volatility, the big down days get a lot of attention. We look at 1% days here, 2% down days, 3% or more down days. And the last few weeks, we've seen a number of these 1% down days, not huge, but that scares a lot of people. And I think it's always important to put that in context, that we see this each and every year. The average year actually has about 30 of these big down days. We've seen 27 so far this year. Still have around 2 months to go. So this is likely to go up from there, but not huge. It's not huge volatility. It's kind of average volatility if we're looking at the historical record. And last year certainly was well above average in terms of volatility, made it a much more difficult year for investors. Of course, the year is not over yet. Anything can happen in the last few months, but so far, this is pretty normal activity for the US equity market. Now, the interesting divide that really I talked about last week and we've been focusing on is the divergence between the S&P 500, which are the largest 500 stocks in the market, and smaller stocks. If we're looking at the Russell 2000 small cap index, from last year's lows, from the closing low on October 12th, 2022, S&P 500 is up almost 18%, but we have small caps actually now down since that closing low. So very big divide here. And as we talked about last week, really the question investors are asking is this what a new bull market looks like? Do you tend to have this kind of broad weakness at the start of a new bull market? And many people were claiming back in July, when the market was a few percent off of its high, this is a new bull market. You should think about this as a bull market that's going to last for a number of years. I think fewer people are thinking that way today, and that's because we have this huge divergence here, and the average stock is certainly not acting like it's in a bull market. Now, where's sentiment after this decline? This is something, of course, that we should all watch closely, looking for extremes. You want to see people more bearish. You want to see more fear in the market. That's exactly what we're seeing here, with the S&P down about 10% from its high in July. We have the percentage of bears in this AAII poll going up from about 20% to over 40%. So roughly 20% increase in the percentage of bears. So as prices have come down, they're 10% lower, more people are bearish. And that's a good sign. That's a good start. Are we at a bearish extreme? No, not by any means. We still have I would say, a lack of any real fear. But if this were to continue to get up around 50%, we would see the VIX spike. The VIX is still kind of hanging around 20. Then that would be an indication of perhaps investors are becoming too fearful, and that would be an additional positive sign. But certainly interesting always to see this play out where prices are lower and people are more bearish. And of course, if you're a long-term investor, should be the exact opposite. You should be getting more bullish each move down. So each 10% move down, you should be that much more bullish. But it seems always to be the case that most investors react in the opposite fashion. Now, prices are moving down in terms of stocks, but how are earnings looking so far coming in? And if we're being objective, earnings are pretty good coming in. So it's a little bit surprising to see this type of weakness in the market, given that earnings are coming in better than expected. Another better than expected quarter for the S&P 500 and for big tech specifically, as we'll talk about. But if we're looking at that big picture, S&P 500 gap earnings, EPS growth, 18% increase year over year. This is with 44% of companies reported. So this number could change a little bit, but certainly better than expectations were coming into the quarter. And what we're seeing now is the third consecutive quarter of positive year over year growth. So that earnings recession that we saw last year, we're quickly coming out of that. We're seeing better comps for companies that cut costs last year, made adjustments to that high inflation period that we saw in 2022, and now we're seeing the positive results of that. And if we look at the aggregate S&P 500 earnings here, we can see earnings peaked there at the end of 2021, and they had that pretty sizable decline last year, but now they've rallied for 3 quarters here, and we're seeing now S&P 500 earnings now only 2% below that peak from late 2021. So pretty strong comeback in terms of earnings. And what's driving that? Well, more than anything else, it's the biggest companies and big tech companies reporting very strong earnings across the board. There's been different reaction in terms of their share prices, but if we look at the actual fundamental data, overall, it's been better than expected, I would say, and particularly on the net income side, just huge, enormous growth over the last year, all of that operating leverage playing out. So let's talk about Google here. 11% increase in revenues year over year. We're looking at a new quarterly high, 77 billion for revenues, and the net income increase much bigger than the top line growth. So you got 42% increase in net income for Google to 20 billion for the quarter. So just huge numbers, obviously, for an enormous company. Microsoft, very similar here. We saw almost 13% year over year revenue growth. So that's picking up, increasing versus the prior few quarters. So rebounding in terms of the top line, a new quarterly high at 57 billion, and net income similar to Google. The increase is better than revenue, showing that operating leverage. 27% increase in net income for Microsoft to a quarterly record for Microsoft, 22 billion. Then we have Meta, or Facebook, whatever you want to call it, up 23% year over year in terms of revenue, actually hit a new quarterly high of 34 billion. Revenue last year, revenue growth for Meta was actually negative. So it's kind of a huge turnaround for the company. And in terms of net income, there's really no comparison. 164% increase for Meta to a quarterly record of 11.6 billion. And if we're talking about profit margins and just looking at that expansion over the last year, it's been across the board here. You're seeing Microsoft operating margins going from around 43% to over 47%, Google moving from 25 to 28, Amazon from 2 to almost 8%, Meta 20 to 40%, and Netflix 19 to over 22% in terms of increase in profit margin. So across the board, you're seeing these companies grow their margins over the past year. Obviously, we'll see if that continues, but certainly a good sign to see this broad trend, and that's driving earnings for the S&P 500 as a whole higher. So let's switch gears here, talking about the housing market, and let's talk about the decision that people have to make of buying versus renting. And oftentimes, you don't see a huge spread in terms of what it would cost you to buy versus what do you call it would cost you to rent. They should be roughly equivalent most of the time. But what we're seeing today is a record spread between what it would cost to buy a home versus rent a home, and it's 52% difference. You'd have to pay 52% more to buy a home than to rent it, which is just an enormous spread. It's even higher than what we saw during the peak of the last housing bubble, which was around a 33% premium. And again, once again, logically, you would expect these to somewhat track each other, because if if it costs too much to buy a home, people will prefer to rent it, and you'd see more demand for rents. Rental prices would go up, and you would think that home prices would come down, and this would adjust. And that probably is going to happen here in the future. We'll see how this plays out, but for now, you're much better off, it seems to be, in most locations, renting rather than buying in terms of that monthly payment. And how did we get here in terms of the cost being so much more to buy a home than to rent it? Well, two factors, of course. Number one being home prices just skyrocketing in recent years, and they still haven't really come down. If we're looking at existing home prices, they're actually higher than they were a year ago. And if we're looking at the second factor, it would obviously be mortgage rates. So if we're looking at Freddie Mac data, 7.8% now for the 30-year mortgage rate. That's the highest since November 2000. And that's simply crushing affordability for the average person looking to buy a home. So if we're looking at that equation of buy versus rent, this is a calculation everybody should do, which is what percentage of your income would it take to afford that home? And you can do that for the rent, and you can do that for the home, and you should include taxes, insurance, you should include all the costs of buying a home in that calculation. And what we see here, data from the Atlanta Fed, most recent data, saying that it would take 44.6% of the median household income to afford that median priced home for sale today, which is extremely high on a historical basis. Usually you don't want to spend more than 30% of your income on housing. And here we're saying at current prices and current mortgage rates, it's going to take almost 45% of your income to afford that home. So the question is, of course, what would the rent be as a percentage of your income? And if it's significantly lower, then people, from a personal finance standpoint, should probably favor that rent until that equation changes. And what about the question that people often ask? Well, aren't I throwing away money if I rent a home versus buying a home? Well, it's not that simple. When you're buying a home, yes, you're building equity, but in the early years, you're building very little equity. Most of that monthly payment is going actually towards interest expense, not towards equity if you break it down. And so if you're planning on living in a home, let's say for only 5 years, well, you're going to be paying way more towards that interest expense than building equity. And the money that you could potentially save by renting versus owning with these additional costs here could be enormous. And you could save enough then, if home prices would normalize or mortgage rates come down, to better be able to afford that home in the future. So it's not that simple in saying you're throwing your money away in terms of rent, because if you're seeing a significant savings from renting a home versus buying a home, that's real money that can compound for you over time. And so do the math, look at the everyone's situation is different, look at the actual data, look at the actual evidence, and then make a decision based on that. Don't just listen to people who say, well, it's always better to buy a home because you're building equity. Well, there's a lot of factors that depend on that, and how long you're going to live in a home, what percentage of your income is going towards that housing payment. All of these factors should weigh into it. So terms of the housing market, what are these higher prices and higher mortgage rates doing in terms of cancellations? What we're seeing, a continued spike in cancellations. So more home purchases are falling through than they have been the previous few quarters. And now we're back to close to the peak levels we've seen over the last decade in terms of cancellations. And you would expect that, because mortgage rates going up as quickly as they are today, it becomes just simply unaffordable if you didn't lock in that rate, and the rate has gone up 50 basis points or 100 basis points in a short period of time, well, you're going to cancel that purchase of the home. And what we're seeing here, interestingly, is kind of a divide between new home prices and existing home prices. And we've talked about this, but existing home inventories just have been so low. That's been keeping prices elevated and even higher than they have been a year ago. But in terms of new home sales, we're not seeing that. We're seeing actually new home prices come down off of their peak. They're now close to 16% off of their peak levels, or looking at the median price. And there's a number of reasons for that. But the biggest driving factor is that you have more supply in terms of new homes, relatively speaking, than existing homes. So that leads to builders offering incentives and cutting prices in order to sell that home. And they're more incentivized, obviously, to get rid of that inventory. Whereas someone who has an existing home could say, well, I'm just going to pull it off the market and wait. So that's one reason. But the other big reason that we've talked about is builders are building cheaper homes, more affordable homes, so lower priced homes with fewer bedrooms. So this isn't an apples to apples comparison here, because the homes that are being built today are smaller than they were, let's say, 2 years ago. So you would expect the prices to be lower. But this is one way builders are confronting that affordability crisis, saying, well, if people can't afford a 4-bedroom home, maybe we'll build more 3-bedroom homes. And that's one way kind of to alleviate the pain for new home buyers, is offer a more affordable option. So it'll be interesting to see if this continues. During the last housing bubble, we saw the median price of a new home go down a little over 22%. So certainly we could say this should, given that affordability is worse, this should go down even more than back then. We'll see if that happens or not. Of course, supply and demand is going to drive everything. So if we see more supply coming onto the market, which it doesn't seem to be looking at housing starts, or we see demand really collapse, well, then you could see prices go down even further. So let's talk about the US consumer and how it boosted the recent GDP number. We expected it to be high. We were talking last week about that estimate from the Atlanta Fed. They do this GDP Now calculation. They were expecting over 5% in terms of GDP. It came in at 4.9%. But no question, the US economy, at least in the third quarter, still expanding. So now we have the economic expansion that started in April 2020, 41 months now in duration, a cumulative increase in real GDP of 18%, annualized around 5%. And a lot of that, of course, came in 2021, rebounding off of the COVID lows. But this quarter here, you can see it kind of stands out compared to where we were, kind of declining the previous 3 quarters. We're seeing a huge bump up here, 4.9% annualized for this number. Now, is this expected to continue? No. You can see the consensus estimates from economists here that the Wall Street Journal surveyed. They're expecting it to come right back down and actually be below where it was in the previous quarter. So looking at below 1% growth if you're looking at Q4 and beyond. So we'll see what happens there. These numbers fluctuate enormously, but I think the broader point is this is kind of a one-off, and people shouldn't be expecting this type of growth rate to continue. And what I like to look at in terms of GDP is really looking at the year-over-year number to kind of smooth out those quarterly jumps that you could see, or quarterly downturns. And what we're seeing here is 2.9% real GDP growth on a year-over-year basis. So certainly an increase from where we were last year. Last year, there was fears, of course, about a recession already starting. We did have 2 consecutive quarters of negative GDP, but we never turned negative on a year-over-year basis in terms of this indicator. And here we are about 2.9% year-over-year, so much less extreme if we kind of normalize this on a year-over-year basis. And we've seen that, of course, that number in prior expansions, that would be nothing out of the ordinary. Now, what was driving that spike higher? What was driving that 4.9% number? Well, biggest factor by far was consumer spending. And in terms of spending, services being the most important component, biggest by far factor contributing to that 4.9% number. But also consumer spending on goods was very high. There was inventory building as well. That was a huge part of it. So a lot of different factors. You had government spending, as we talked about. They're borrowing a lot of money, spending a lot of money. That's part of GDP as well. So all of these factors contributing, but the U.S. consumer definitely the biggest factor, and services by far, spending there seems to be the largest contributor. And if we look at the uh, increases in spending in terms of services versus goods since the start of 2022, we're seeing a transition here. So in 2021, there was a lot of spending on goods after the stimulus. And in terms of today, it's a lot of spending on services. So people are going out more, they're traveling more. We talked about the travel boom that we had over the summer, and that's translating now into GDP and spending on services. And people are going out to live events more and more, and they're spending on it. So now we have consumer spending on movies, live entertainment, sporting events at a new peak, and a pretty sizable increase versus last year. So all of these factors are driving that increase in that services spending from consumers. And if we let's zero in and talk about concerts, we've talked about Taylor Swift, and the spending there just enormous over the course of this year. And ticket prices now for the average ticket price for a top 100 tour in America is now $120. So not cheap anymore to go to a concert. And that's actually, I did the numbers here, 73% higher than where it was a decade ago. And you can see the difference just in the last few years, rebounding from that COVID dip and rebounding and then some, hitting a new record high, and now just a huge increase over the last 10 years, and huge demand. There's a lot of pent up demand where people didn't get to go to live events, and now they're going and spending, and that's helping GDP. Last point on consumer spending. This is Halloween's coming up here, and this is a number that surprised me. I didn't know it came anywhere close to this, but they're expecting Americans to spend $12.2 billion on Halloween this year, which would be a 15% increase from the spending last year. And the percentage of people celebrating Halloween is expected to hit a record high this year. And you can see the dip that we had in 2020 from COVID. So just a huge resurgence in consumer spending, and seems to be, for now, keeping the economy in an expansion. Again, don't expect Q4 to show that type of number, but the good news is that we still have an economy expansion, we still have employment growth, and all of these factors are contributing to higher GDP. So let's talk about the car market, which historically was always viewed to be a depreciating asset class. There wasn't really a debate about this unless it was some type of collectible car. The minute you bought a car, the minute you left the lot, it would have go down in value. And that was kind of the joke, that you drive off the lot after you buy it, and it would go down 10%, 20%, whatever it is. And that all of that changed back in 2020, 2021. We had this absolute mania and supply shortage leading, and we had a lot of demand, and people had all of this extra money from the stimulus, and that drove up prices significantly to the point where people had heard about flipping houses, of course, but no one had ever before talked about flipping cars. And I just pulled a few of the headlines that were going on back in the summer of 2022. Tesla owners are flipping their cars like houses. Opportunists are flipping Teslas for a $7,000 profit, and reselling new cars suddenly comes with absolutely insane profit. So this was insane. That I talked about at the time. This was not going to last. People shouldn't view these things as appreciating assets. They are definitely not. And what we've seen since then is a normalization and then some. So the average used car price for a Tesla was hit a peak of $67,900 back when these headlines were coming out in July 2022. And you could just see the enormous increase, the mania increase that led to these headlines, where you could buy even a used car. They were talking about new cars there, but even a used car and sell it a few months later and make thousands of dollars. Well, since then, we've seen a move back to reality. And the average price of a used Tesla today is now $28,000 lower than it was in the peak in July 2022. That's a 41% decline. Now, of course, today, nobody's talking about flipping Teslas anymore. No one's talking about these things being appreciating assets. And what led to this decline? A number of factors. Biggest one, of course, more supply came into the market. The supply chain issues have eased. The consumer that was flush with cash back after the stimulus, a lot of that has been spent. And big factor, just zeroing in on Tesla, has just simply been the price cuts, the enormous price cuts that they've done over the last year in terms of new cars. So if they're cutting the price of a new car by 25%, a used car is definitely going to go down at least that much, if not more. And that's exactly what has occurred. And Tesla is definitely an outlier here in terms of the run up that we saw, and now in terms of the declines. Tesla has cut prices way more aggressively than any other automaker over the last year. Looking at a sampling here of different auto manufacturers, and most of them have actually increased their prices over the last year. Tesla really stands out here, down 25%. No one's even close. And we talked last week about what Musk and his goal is to have more market share. He wants to make cars more affordable. He's viewing this as a way to grab market share, and he's willing to sacrifice profits and margins in the short run. We talked about the big hit to profits last quarter, and that's likely to continue as long as they continue this pricing. And what he keeps saying is we have to make cars more affordable. We've talked about how interest rates have driven up the cost of cars. Most people finance the cost of a vehicle. Interest rates have made it unaffordable for a lot of people, and he's trying to bring prices down, and that's really an outlier. Now, most used cars are lower over the last year. Let's say the average decline is around 5%, but Tesla, we're talking about 30-40% declines over the last year. Just unbelievable. And that gap between the price of a Tesla and the average price is narrowing very, very fast here. I think the average used car price is around 28,000. So that was an enormous spread back in July 2022. And today, that spread, you're talking about maybe a $10,000 difference in terms of the average price versus a Tesla. So it used to be out of reach for a lot of people in terms of buying a Tesla. And today, much, much more affordable. We'll see if this strategy that Tesla has ends up working out. But no question, it's going to put pressure on other automakers in terms of their increasing prices and Tesla's cutting prices. How are they going to sell as many vehicles, assuming we have a similar vehicle? Of course, you're going to pick Tesla if you're getting more value for that. And so this brings up an important question here in terms of the deal that was just struck between Ford and UAW. And the UAW union leader said that Ford had to pony up. That was what he was saying. And Ford, according to this tentative deal, ended up ponying up, and by a good amount here. We're looking at a 25% wage hike over a 4.5-year contract. First year gets an 11% increase, and they're saying that if you include cost of living mechanisms, it's really going to be a 33% increase. Anyway, you look at it, pretty substantial increase in terms of labor costs for Ford. You expected it to be high, but this is going to be crushing. And if we look at the Ford stock price here, it also reported earnings this week, just taking a big hit on both of these factors here, now actually down 4%. And I think the big question here in terms of the unions is the rallying cry has been, well, Ford is making these enormous profits and they're not sharing it with their workers. And this is kind of righting those wrongs. And what I showed a few weeks ago, I'm going to show it again here. Ford has made absolutely no progress over the last 10 years in terms of the shareholder returns. It's actually down versus 10 years ago. Profits are no higher than they were 10 years ago. And if we look at a company like Tesla with non-unionized workforce, 1,760% return in terms of its share price, night and day, Tesla versus Ford. And we talked about Tesla is now aggressively cutting prices, while Ford is likely to be forced to raise prices if they want to maintain their profit margins due to these labor cost increases. So that might put additional pressure on it. So in the short run, very good deal for the workers at Ford. You wonder what the long-term impact is. Is it going to cost them jobs in the future because Ford is going to have such a difficult time remaining profitable? They're going to have to cut the labor force. They're going to probably have to go increasing towards automation, and those jobs will be eliminated. So it remains to be seen what the long-term impact is. But kind of that narrative that Ford was doing extremely well before this agreement here, that doesn't really stand out here if you're looking at the actual numbers in terms of their profits, in terms of the share price. It already was struggling going into this, and now it seems like that it's going to put additional pressure on it as well, and just not going to be competitive versus Tesla. The ultimate question is, well, what is the market paying? What is that market saying that the labor cost should be? What should that benefit be? And if Ford and GM, these other unionized companies, if they're paying a premium over what the market is at, well, then they're going to suffer for that. And other companies that are not paying that premium are going to take share from them. So that's the ultimate question. We'll see how it plays out. But clearly, Tesla is the big winner from these negotiations, at least it seems to be today. So let's talk about the Fed, the unwinding of excesses. And it was an enormous excess that we saw in 2020, trillions of dollars in terms of them buying not only treasury bonds, but mortgage bonds. We talked about the crazy situation where we had a housing bubble, and the Fed is going out and buying billions of mortgage bonds every single week, driving that interest rate lower and causing prices to escalate that much higher. It's a huge policy error. They've never owned up to it. But here we are today. They're starting to unwind that. And so what we've seen so far is a $1 trillion now decrease in their balance sheet. And they're simply letting the securities that they bought roll off. So they're not outright selling these securities that they had purchased, but when they mature, they're just letting them roll off their balance sheet, and they're not replacing them with new securities. And we're seeing this now continue month after month, this quantitative tightening. But the question is, how much more quantitative tightening would be necessary to erase what they did during 2020 and 2021? And the answer is over another 3 trillion. So yes, we're on the way to normalization, but there's still a ways to go to get back to where we were before. Perhaps we'll never get there. A lot of people are saying we won't, that none of this, it's not realistic to believe that this will be erased, but we'll see what happens. My standpoint is the Fed wants to see this continue to normalize, and they would like to let it continue to normalize, but at some point, the market or the economy is going to turn down enough, and they're going to say, we can't do it anymore. And looking at mortgage rates at close to 8%, and the Fed no longer being a buyer in that market, we've seen the problems that's caused for the mortgage market. It's where the mortgage rate should be, right, based on supply and demand. But the Fed had been manipulating that rate for so long that it's just such a harsh adjustment to the system to do that. So I don't think the Fed is done with this idea that they should be influencing markets. And obviously, I don't agree with that. But for now, at least, I think they've recognized that inflation, if they want to get it back down to their 2% target, they're going to have to continue, at least in the short run, to operate under this restrictive policy and let this roll off. My preference would be for them to get the pain over with and go out and sell the securities that they bought, but they're not going to do that. They're just going to continue to let it roll off here. So if we're looking at the impact this is having on the money supply, you can see here down 3.6% over the last year. This is now the 10th consecutive month where the money supply has declined on a year-over-year basis. We've never seen that before with data going back to 1960. And if we look at a 2-year change in the money supply, what a difference the last 2 years has been compared to where we were before that. In 2020, 2021, you saw an over 40% increase in the money supply. Just a crazy, crazy expansion that we've never seen before in history. That obviously led to inflation rate hitting its highest levels since the early 1980s. And now we have the opposite situation where the money supply is actually down over the last 2 years, something we haven't seen before, again, with data going back to the early 1960s. So, good sign in my view that we're normalizing, certainly having an impact in terms of markets, certainly having an impact in terms of inflation. The Fed has to have the will to continue to normalize this. Now, it's not going down by a huge percentage. I don't think they want to do what they did during the Great Depression, where we saw a significant decline in the money supply. They definitely don't want that, but they have to find a way to unwind some of this excess if they want to get inflation really under control for the long term. And hopefully they learn the lesson that you can't do what they did without having unintended consequences. So I want to end, as I always do, with a positive news story here. And to me, inflation still the big issue for markets, still big issue for most people. And if we're looking at core inflation, this is the Fed's preferred measure. This excludes food and energy. This is what they look at in terms of figuring out their policy. Well, the core PCE data that we just got came down again. Now it's down to 3.7%. And that's the lowest rate of core inflation we've seen since May 2021. So continue to make progress here. We expect this to continue to come down because, and we've talked about this, shelter is the biggest component here. And with a lag, that is going to be reflected in this number. So we're likely to see this continue to come down. And what's interesting is the spread between the Fed funds rate and this core PCE is now at its widest level. So most restrictive monetary policy that we've seen in the US since 2007. So a couple of points here. Number one, everyone's asking, well, why hasn't monetary policy pushed the economy into a recession yet? Well, there's a lag, and really it's only been restrictive here for a very short period of time. And it very well might take a few more months before additional restriction, before it pushes the economy into a recession. That would be the first point. And the second point would be, well, perhaps we're not going back to this regime where we had ultra low rates and rates for years on end below the rate of core PCE. So maybe there has been a structural change in the way the Fed is going to think about this in the future, where they're not going to make the base case policy that ultra easy stance. Now, we won't know that until we get another downturn, until unemployment rate really rises, until the Fed is pressured to kind of choose between restrictive policy and easing policy. When that comes, then we'll see how the Fed reacts. But the good news for most people is that the inflation rate is not spiking back up. We're not seeing a resurgence just yet. And the next month's data, if we're looking at October data, I expect it to be, in terms of CPI, to come back down again, probably down to around 3.3%. And we're seeing gas prices and other things start to normalize. And so a lot of positive signs on the inflation front. We just got to keep fighting the fight. And that's going to be harder to do the more the stock market goes down and when we really start to see economic weakness. But it's something that we have to do if you want to have long-term prosperity. So if you're a market participant, you're probably thinking about what the Fed is going to do next week. Are they going to hike rates again? And the answer is very much no. The Fed's going to pause once again. Again, there's a 0% probability now priced into the markets in terms of that November 1st meeting. And as I've said, before every Fed meeting, the Fed does exactly what the market's expecting it to do. So the day before that meeting, I'll do my usual tomorrow's news today and say that the Fed will once again hold rates at 5.25 to 5.5%. And perhaps they're done hiking altogether. You know, they've talked about perhaps one more hike this year. But if we look at the recent data, and if this core PCE is going to continue to come down, they probably don't feel like they have additional pressure to hike rates again. And the other big factor, of course, being that the bond market has been doing the job for them. So the increase in long-term interest rates, increase in mortgage rates, increase in car loan rates, increase in credit card rates, all of these factors are likely to cause a slowdown without the Fed doing an additional hike here. I don't think it really makes a difference if they go another 25 basis points, but they certainly, given the current data, will not likely feel pressure to do that unless we see, I would think, unless we see a move in CPI, let's say back above 4%, where it seems like it's going to become an issue again. I just don't see the urgency from the Fed to hike again this year, at least. So we'll end it right there. Have a great weekend, everyone. Thanks for joining. If you like the content, as always, hit that subscribe button, and I'll see you next time on the Weekend Charts.